What if you could support small businesses in your region, help your local economy grow, and at the same time get a big tax cut from the French government? That's exactly what the FIP, or Fonds d'investissement de proximité, is designed for. Welcome back to the channel. Today we're talking about the FIP, a little-known investment product in France that's all about backing local companies and reducing your taxes. We'll cover how it works, who it's for, and whether it's worth the risk. Let's dive in. Before we dive into today's topic, please note that the information provided in this video is for educational purposes only. It is not financial, investment, or tax advice. You should always consult with a licensed professional before making any financial decisions based on this content. FIP stands for Fonds d'investissement de proximité, which means Local Investment Fund. It's a type of investment fund that puts your money into small and medium-sized companies, often startups or growing businesses, located in specific French regions. The government created FIPs in 2003 to encourage private investors to support local economies and job creation. In exchange for taking the risk of investing in small companies, you get a big tax reduction. A FIP is an investment product, not a savings account. That means it carries risk, but also offers higher potential rewards. When you invest in a FIP, your money is pooled with other investors' funds. Professional managers select 60–70% of companies from the target region. The rest can be invested in other small businesses or financial instruments. Example: Claire invests $10,000 in a FEP focused on Provence-Alpes-Côte d'Azur. Her money might be split across a winery, a tourism company, and a small IT services firm. If those companies do well, she profits. If they fail, she could lose part of her investment. Here's why people invest in FIPs. Big tax cuts. You can deduct up to 25% of your investment from your income tax bill. That's $2,500 saved on a $10,000 investment. Support for the real economy. You're helping small French businesses grow. Potential capital gains. If the companies succeed, your investment could grow significantly. Tax-free gains. If you hold your shares for at least 5 years, any profits are exempt from income tax, though social charges still apply. For many investors, the tax reduction is the main attraction, and any profits are a nice bonus. But FIPs aren't for everyone. Here are the risks. High risk. Small companies can fail, especially startups. You could lose part or all of your money. Illiquidity. Your money is locked in for at least 5 years, often 7 to 10 years. Complexity. It's hard to track the performance of every company in the fund. Fees. Management fees can be higher than in other investments. So FIPs are really for people who can invest long-term money they won't need soon. Here's how it works. Go through a bank, wealth manager, or online investment platform that offers FIPs. Choose a fund by region, for example, FIP Corse, FIP Outre-mer, or a metropolitan region. Fill out the subscription form and transfer your funds. At tax time, declare your investment to claim the 25% income tax reduction. Minimum investment amounts vary, but often start at $1,000. FIPs are locked in. You can't sell your shares before the minimum holding period, usually 5 to 7 years. Once the fund manager sells the companies in the portfolio and closes the fund, you'll get your share of the proceeds. If the companies did well, you might get back more than you invested. If not, you could get less, but you keep the initial tax break. Here's the tax breakdown. 25% income tax reduction on the amount you invest, up to $12,000 for a single person, $24,000 for a couple. Capital gains after 5 years are exempt from income tax, but you still pay 17.2% social charges. So if you make $2,000 in profit after 6 years, you only pay $344 in social contributions. Final thoughts. Please note that the information provided in this video is for educational purposes only. It is not financial, investment, or tax advice. You should always consult with a licensed professional before making any financial decisions based on this content. The Fonds d'investissement de proximité is a unique way to combine investing with community support and get rewarded with a big tax break. It's ideal if you want to support small French businesses. You can take investment risk. You can lock your money for several years, but it's not a substitute for safe liquid savings. It's a niche, long-term strategy. Thanks for watching. If you found this useful, hit the like button, subscribe for more French finance tips, and let me know in the comments. Would you invest in local businesses if it meant a big tax cut?